Dramatic price chart showing paper silver decline versus physical premium spike. While you were sleeping, the silver market just exposed the biggest disconnect in modern financial history. Paper silver contracts on the COMEX crashed 40% in under 6 weeks. But here's what's absolutely insane. Physical silver demand exploded 250% during that exact same period. U.S. Mint Silver Eagle sales hit record levels. Refineries are running 24/7 and still can't keep up. And if you think this is just another precious metals hype cycle, you need to see what happened in the last 72 hours. Because what I'm about to show you suggests we are not just witnessing a price correction, we're watching the early stages of a breakdown between paper and physical silver markets that could trigger the largest short squeeze in commodity history. I'm going to break down exactly what's happening, what the smart money is doing right now, and the 3 critical price levels you need to watch in the next 30 days. But first, let me show you the data that Wall Street is desperately trying to downplay. 2:30, market now. Facts and data. On screen, live silver price ticker plus key metrics. All right, let's cut through the noise and look at where we actually stand as of February 2026. Current market snapshot. Spot silver is trading at $28.40 per ounce. As of this morning, we're down from the January high of 34.20. That's a 17% correction in just 4 weeks. But, and this is critical, physical premiums have doubled. Let me explain what that means. When you go to buy actual physical silver right now, online dealers are charging $6 to $8 over spot price. 6 months ago, those premiums were $2 to $3 for American Silver Eagles. You're looking at $10, $12 premiums. Some dealers have 3 to 4 week wait times for a metal that's supposedly crashing. The numbers that don't add up, according to the latest Silver Institute report published January 28, 2026, global silver demand hit 1.21 billion ounces in 2025. That's up 18% from 2024. Industrial demand alone jumped 23%, driven by solar panels and EV electronics. Investment demand surged 250% year over year. Meanwhile, COMEX registered silver inventories, that's the physical silver actually available for delivery, dropped to just 47 million ounces. That's the lowest level since 2015. So we have skyrocketing demand, collapsing available inventory, but the paper price is down 17%. Something doesn't add up, and that something is about to become very, very expensive for someone. WOM4i30, competitor narrative comparison. On screen, split screen showing other YouTube thumbnails. Now, if you've been watching other silver channels lately, you've probably heard one of 2 narratives. Narrative number 1, silver is going to $100 by March because of insert conspiracy theory. Look, I respect the enthusiasm, but that's not how markets work. These clickbait predictions without actual market mechanics do more harm than good. Narrative part 2, silver is crashing, the bull market is over, get out now. This is the mainstream financial media take. CNBC ran a segment last week titled Silver's Shine Fades, while completely ignoring the physical market dynamics. Here's what's actually happening and why it's different. Unlike those other videos telling you to panic buy or panic sell, the real story is about a structural market dislocation that's been building for 18 months. What we're witnessing is a classic divergence between paper markets, COMEX futures, ETFs, derivatives, controlled by banks, hedge funds, and algorithmic traders. Physical markets, coins, bars, industrial consumption, driven by actual supply and demand. This isn't new. We saw this exact pattern in 2008 before silver rallied 400% by 2011. We saw it again in 2020 before the 130% rally. But this time, there are 3 factors that didn't exist in previous cycles. Factor number 1, central bank silver accumulation has increased 340% since 2023. Yes, central banks are quietly stacking silver now, not just gold. Industrial demand from the green energy transition is structural, not cyclical. Solar panel manufacturers alone will consume an estimated 180 million ounces in 2026. That's 15% of total global supply. Factor 3, the COMEX leverage ratio, paper claims versus physical silver, is now estimated at 250:1. That means for every ounce of physical silver, there are 250 paper claims. If even 5% of paper holders demand delivery, the system breaks. That last point, that's what keeps bullion bank risk managers up at night. 07 to 845, bullish forces, structural drivers. On screen, data visualizations for each point. Let us talk about why institutional money is quietly positioning for higher silver prices despite the recent sell-off. These are the real bullish forces, not speculation, but structural multi-year trends. 1. Industrial demand acceleration. Silver isn't just a monetary metal anymore. It's become critical infrastructure for the energy transition. solar panels. Each panel requires about 20 grams of silver. Global solar installations are projected to hit 650 gigawatts in 2026. That translates to 180 million ounces of silver-demand electric vehicles. Each EVI uses 25-50 grams of silver in electronics. EV sales grew 35% in 2025 and are accelerating 5G infrastructure. Silver's superior conductivity makes it essential for high-speed data transmission. This industrial demand is inelastic. Solar companies can't just decide to use less silver because the price goes up. It's required for panel efficiency. They have to buy it regardless of price. The Silver Institute estimates industrial demand will grow 8 to 12% annually through 2030. That's baked in. 2. Supply constraints. Intensifying. Meanwhile, on the supply side, we're facing serious headwinds. Primary silver mines, where silver is the main product, have declined in production for 3 straight years. 70% of silver comes as a byproduct of copper, lead, and zinc mining. So silver supply is tied to other metals. Major mining regions in Mexico and Peru are facing resource nationalism and higher royalty taxes. Discovery of new major deposits has collapsed. We're running out of easy silver. The World Silver Survey shows that even with silver at $35 Oz, new mine development takes 7 to 10 years. The supply deficit can't be fixed quickly. Why debasement and inflation hedge demand? Now let's talk about the monetary side. Since 2020, the Fed's balance sheet expanded from $4 trillion to over $8 trillion. M2 money supply increased 40%. Real interest rates, after inflation, remain negative in most developed economies. History shows that in environments of monetary expansion, hard assets, especially silver, act as a pressure relief valve. Here's what's new. For the first time, we're seeing major hedge funds and family offices allocate to physical silver, not just paper ETFs. Sprott Physical Silver Trust added 8.2 million ounces in January alone. That's physical silver coming out of the market permanently. 4. Gold to silver ratio. Screaming, buy silver. The gold to silver ratio currently sits at 88. 1. That means it takes 88 ounces of silver to buy 1 ounce of gold. Historically, the ratio averages 65.1 over the past 30 years. During silver bull markets, it drops to 50.1. At the 2011 silver peak, it hit 32.1. If this ratio just reverts to the 30-year average of 65.1, with gold at $2,850, silver should be trading at $43.85. That's a 54% upside from current levels. 5. Short position vulnerability. According to the latest CFTC Commitment of Traders report from January 31st, commercial traders, the big banks, hold net short positions of over 45,000 contracts. That represents 225 million ounces of silver. Open interest has surged while registered inventory has collapsed. This is a textbook setup for a short squeeze. If prices start climbing and shorts need to cover, they'll be buying into a market with extremely limited physical availability. We saw this play out in March 2020, when silver briefly spiked to $30 before the broader COVID crash. Smart money knows this pattern. 11. Haas. Risks and bearish signals. The honest truth. On screen, risk assessment graphics. All right, now let me show you why I'm not one of those permeable silver channels that only tells you what you want to hear. Because if you're going to invest in silver or any asset, you need to understand the real risks, not just the upside case. Bearish signal number 1, technical breakdown. Let's be honest about the charts. Silver broke down through critical support at $30 in late January. We're now testing the $28 level, and if that fails, next support is at $26.50. Below that, we could see $24. The 50-day moving average just crossed below the 200-day. That's a death cross in technical analysis terms. Short-term momentum is clearly bearish signal number 2, Fed policy uncertainty. The Federal Reserve has signaled potential rate hikes if inflation remains elevated. On January 29th, Fed Chair Powell indicated that rates might need to stay higher for longer. Higher interest rates are historically negative for non-yielding assets like silver. Why hold silver when you can get 5% in a money market fund? This is a real headwind, and you need to factor it into your risk assessment. Bearish signal number 3, stronger dollar. The US dollar index, DXY, has rallied 4% in the past 3 weeks. Since silver is priced in dollars, a stronger dollar typically means lower silver prices. If the dollar continues strengthening due to safe haven demand from global uncertainty, interest rate differentials favoring the US, de-dollarization fears being overblown, then silver could face continued downward pressure despite strong physical demand. Bearish signal number 4, recession risk, could hammer industrial demand. Remember, 60% of silver demand is industrial. If we enter a global recession, Solar panel installations could slow, EV sales could decline, electronics manufacturing could contract. The Conference Board's leading economic index has been negative for 8 consecutive months. If recession hits, industrial silver demand could drop 15-20%, overwhelming investment demand. Bearish signal number 5, ETF outflows. Continue the largest silver ETF, SLV, has seen net outflows of 22 million ounces since December. That's institutional money leaving. The paper silver market. While physical demand is strong, paper market sentiment drives short-term prices. If ETF outflows continue, we could see more downside before the physical shortage becomes the dominant price driver. The manipulation? Question. I know many of you are thinking, but what about price manipulation? Aren't the banks suppressing silver prices? Look, there have been proven cases of price manipulation. In 2020, JP Morgan paid $920 million in fines for spoofing metals markets. It happened. But here's my take. Whether manipulation exists or not, you can't build an investment thesis on it. Markets can be manipulated far longer than you can stay solvent. Focus on what you can measure: supply, demand, industrial trends, monetary policy. Don't bet the farm on a short squeeze that might never come. Bottom line on risks. Silver is volatile. It can easily drop another 15-20% before rallying. If you can't handle that volatility, if you need this money in the next 6-12 months, silver is not for you. This is a 3-5 year structural play, not a get-rich-quick scheme. 1330. What smart money is doing right now? On screen, institutional buying data. So, with all these bullish structural forces and real bearish risks in play, what are the big players actually doing? Because talk is cheap. Let's follow the money. What billionaires and institutions are doing. Ray Dalio's Bridgewater Associates increased precious metals allocation by 23% in Q4 2025, specifically increasing silver exposure through mining stocks. Sprott Asset Management launched a new physical silver fund in December 2025 that has already accumulated $340 million in assets. That's real physical silver being vaulted. Tudor Investment Corporation, Paul Tudor Jones, stated in a January interview that he's holding 5% of his portfolio in precious metals, calling them the best inflation hedge when government spending is out of control. Central bank activity. This is huge, and almost nobody is talking about it. According to Metals Focus, central banks in emerging markets purchased 12 million ounces of silver in 2025, a 340% increase from 2024. While tiny compared to gold, the trend shift is significant. What retail investors are doing? According to data from major bullion dealers, January 2026, U.S. Mint Silver Eagle. Sales, 3.2 million coins, the highest January on record Perth. Mint Silver sales, up 178% year-over-year online dealer traffic. SD Bullion and ApeMex report web traffic up 220% in January. But here's the disconnect. While retail is buying physical aggressively, they're scared. Social media sentiment is 65% bearish, despite record buying. That's usually a contrarian indicator. What I'm seeing in the options market, this is where it gets really interesting. Looking at COMEX silver options, call buying, bullish bets at $35 and $40 and $50 strikes. For June 2026 has increased 340% buying, bearish protection, is minimal below $25 a dollar. This suggests smart money is hedging for explosive upside while accepting near-term downside. The options market is pricing in a 28% chance of silver above $40 by year end. 6 months ago, that probability was just 8%. What smart money isn't doing? They're not panic selling physical into this dip. They're not leveraging up with margin. They're not making all or nothing bets. 1645. What investors must watch now? Key triggers. On screen, dashboard of key indicators. All right, here are the specific things you need to monitor in the next 90 days. These are the triggers that will determine whether silver breaks to new highs or crashes to 24. Trigger number 1, the $26.50. Support level. This is the critical technical level. If silver closes below $26.50 on the weekly chart, we could see a flush down to $24 or even $22. But here's why I'm watching this closely. At those levels, physical buying would likely go absolutely parabolic. Premiums could hit $15, $20 over spot. That kind of buying pressure could create the bottom. Watch for weekly closes above or below $26.50. This is your line in the sand. The trigger number 2, COMEX inventory levels. Current registered silver, 47 million ounces. If this drops below 40 million ounces while open interest stays elevated, we're approaching a delivery crisis. Watch for the CME Group releases this data daily. If registered silver drops below 40 millimolars while open interest exceeds 180,000 contracts, alarm bells should be ringing. Trigger number 3, Fed's next move. March FOMC meeting. March 18th, 2026. The Fed announces its decision. If they signal rate cuts, silver could rally 10-15% immediately. If they hike or stay hawkish, expect another leg down. Watch for Fed.plot projections and Powell's press conference language about inflation and employment. Trigger number 4, industrial demand data. The next major report comes from the Silver Institute in April. Watch for if industrial demand is tracking above 800 million ounces annually, indicating continued strength despite recession fears, that's extremely bullish. If it's tracking below 700 million, the bearish case strengthens. Trigger number 5, gold to silver ratio, currently at 88:1. If this ratio breaks above 95.1, silver is severely underperforming and could go lower. If it breaks below 80.1, silver is starting to outperform. Very bullish. Watch for the GSR breaking and holding below 80 for more than 3 consecutive days. Trigger number 6, US dollar index, DXY, currently around 107. Break above 110, very bearish for silver. Break below 103, bullish tailwind for all commodities. Watch for weekly closes that break, these key levels. Trigger number 7, Chinese economic stimulus. China announced potential stimulus measures on January 20th. If they follow through with significant infrastructure spending, industrial silver demand from China could surge. Watch for any announcements of infrastructure spending above $500 billion, particularly in green energy sectors. Number 8, banking sector stress. This is the wild card. If we see another banking crisis, like March 2023's regional bank failures, safe haven demand for physical precious metals could explode. Watch for bank credit default swap spreads widening, deposit outflows accelerating, or Fed emergency lending facilities being activated. How to monitor? I track all of these using a combination of finviz.com for technical charts and screening, TradingView for real-time price action, CME Group for COMEX data, Federal Reserve website for policy updates, Kitco and Silver Institute for industry-specific data. Set up alerts at key price levels and check these indicators weekly, not daily. Daily noise will drive you crazy. 20, needed strategic positioning and closing. On-screen strategy framework visual. Let me bring this all together with a clear framework for how to think about silver positioning right now. My personal view, not financial advice. I think we're in the middle innings of a multi-year silver bull market that will see prices well above $50 by 2028. But, and this is critical, I also think we could see 24 to 25 silver before we see 40. Why? Because the paper market controls short-term prices, but the physical market will ultimately determine long-term prices. The disconnect we're seeing is the transition from paper dominance to physical dominance. That transition is messy, volatile, and unpredictable in the short term. 3, positioning strategies. Based on your risk tolerance, conservative, lower risk, 5 to 10% of investable assets in physical silver, coins, bars, dollar cost average over 6 to 12 months. View any dip below $26 as a buying opportunity. Hold for 3 or 5 years minimum. Accept volatility as the price of potential outsized returns. Moderate, balanced approach. 10-15% allocation split between physical, 60%, and silver miners. ETF, like CL, 40%. Add on dips below $20. Trim 20-30% of position. If we hit 38.40, rebalance quarterly. 3-5-year time horizon. Higher risk reward. 15-25% allocation, including physical, miners, and leap call options. Use options for leverage on breakout above $32 trade around a core position. Be prepared for 30-40% drawdowns. This is for experienced traders only with strong risk management. What I'm personally doing. I hold a core position in physical silver that I've been building since 2022. I'm using this dip to add small amounts on the way down. Specifically, I'm buying $500 to $1,000 of silver every time we drop another dollar from here. If we hit $24, I'll deploy a larger slug, maybe 5% of my net worth. Why? Because the structural bullish case, industrial demand, supply constraints, monetary debasement, hasn't changed. Only the timing is uncertain. What you should not do, don't leverage up and go all in on margin. You will get liquidated. Don't panic, sell physical silver because the paper price drops. Don't trust anyone promising you exact price targets and dates. Don't invest money you need in the next 1-2 years. Don't ignore the bearish case just because you want silver to go up. Final thoughts. The paper silver crash, combined with exploding physical demand, is telling us that something fundamental is breaking in this market. Whether that break leads to a final flush out to $22 before a massive rally, or a slow grind higher as physical shortages gradually overwhelm paper selling. Here's my question for you. Where do you think silver is headed by the end of 2026? Drop your price target in the comments below. I read every single one, and I'll compile the audience consensus in next week's video. If you found this analysis valuable, smash that like button. It helps the algorithms show this to more people who need to see the real data, not just hype. And subscribe with notifications on because I'm tracking these 8 triggers weekly, and I'll update you the moment we see a major shift in any direction. And subscribe with notifications on because I'm tracking these 8 triggers weekly, and I'll update you the moment we see a major shift in any direction. Remember, invest based on your own research, manage your risk, and never invest more than you can afford to lose. I'll see you in the next one. Stay sharp.